Good Tuesday morning, 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, from Seoul to Wall Street, global stocks get a reality check as tech shares slide again.
Adding to that, SpaceX tries to shake off 3 days of losses and defend its $2 trillion valuation.
Beyond tech, currency traders are on high alert as the risk of yen intervention rises.
A lot of pain in today's market, especially if you're one of those retail traders in Korea. Circuit breakers down 10%, but it kind of flows through to today's session. Let me show you pre-market some of the big tech names. NVIDIA down 2.6%. Micron, we're going to get earnings from them this week, down another 9.4%, and SpaceX is also down. So they're selling gains, the AI on the AI trade, that huge slide in Korea's Kospi exchange. SpaceX stock has been fluctuating this morning, but now decidedly lower. So it's in danger of opening below $2 trillion.
Yeah, fourth day of drops for SpaceX stocks. IBM among the few big tech gainers today as it joins the OpenAI Daybreak Cyber Partner Program, and JP Morgan also upgrading the stock to an overweight. So Big Blue gaining 4.25%.
So outside of IBM, let's discuss the broader sell-off. Joining us now is Bloomberg macro strategist Michael Ball. Michael, when you look at something like the Kospi, hitting circuit breakers, selling off 10%, does this seem to suggest that what's going on today is more technical, or was this rally always in danger of unwinding itself?
Yeah, both. It's positioning. People got ahead of themselves. I mean, they're really YOLO cowboys over there. They're totally leveraged up. They're chasing after two names. They got a fundamental story that makes sense. And funny enough, the valuations aren't quite as crazy as you'd think, given the price moves. But overall, when it's built on this much leverage, this much option buying, it has to eventually correct because the implied vol, or how much you need to get basically compensated by, is just unreachable.
Why not just borrow yen to buy this stuff? I mean, it only gets weaker, right?
Yeah, well, that's another worry now. As a macro catalyst, people are watching for yen intervention. So to your point, the sort of FX world, although the vol has come quite in, is still sort of percolating back as a risk because obviously we want to see some stability there as well.
But dude, how much intervention would they have to do to actually move the market? The market doesn't buy it. So they're just throwing billions and tens of billions and potentially hundreds of billions of dollars at this problem.
Until we see a really credible path to higher rates there, which funny enough would probably ease pressure off the back end of the yield curve and funny enough, obviously support the yen. It's, to your point, you're throwing money at the wall and only some of it's going to stick and the market's going to continue to call it out.
I just say it feels like an overall really jumpy market, and how much of that hinges on a Micron earnings this Wednesday?
Yeah, so that's obviously going to set somewhat of a tone. We still have a decent price there, meaning when we look at how much the valuation is there, it's not expensive, and it's also not this cyclical play anymore. There's a longer-term story with AI, but as we saw from SK Hynix, there's memory shortages elsewhere, so it can't all be about AI. We're actually having electronics and other sort of production now be impaired by a lack of chips for just your standard off-the-shelf kind of stuff. So this is what the market, again, is trying to figure out. How capacity constrained is the AI trade? Obviously, the memory stuff in front and forth for the last 24 hours. But overall, when you have this much leverage and this much price action as far as we rallied, it has to come off sometimes. It's just unsustainable. So that's what it seems like.
What's going on with the ETF stuff, like those levered ETFs all of a sudden don't have enough stock that they can actually put in them?
Yeah, so the assets under management have grown like exponentially for a lot of these ETFs. So for the SK Hynix one, for example, they were having trouble sort of replicating the exposure they needed with what they were getting in as far as flows. So they were having, so dealers and everyone was kind of turning away some of these ETFs and saying, we're not really willing to take the other side of this trade.
All right, so a lot going on. You're all over it. Your team is all over it. Check out Michael's work and the work of his colleagues by typing MLIVGO on your Bloomberg terminal. Now, SpaceX shares are fluctuating amid a broader AI sell-off. They were down most of the pre-market, jumped up for a bit, and have now dropped again off, as you can see, 2.7%. Bloomberg tech host Ed Ludlow here to talk to us about, I guess, stock fall is what we could call this, as they also launch a capsule into space and try to recover it.
Yeah, it's psychological, right? Because $150 a share is the opening trade of Friday, June 12th, the debut trade for the biggest IPO in history. And I think, a lot of focus on like, well, that would put the market cap at or just below $2 trillion. That's part of the mechanics of the post-IPO trade. And like we've done a lot on this program about the history of how IPOs at that level, though this somewhat precedented gone trade, Probably a part of it is linked to the 5-part debt deal, maybe, and this idea that you either are, from a credit perspective, pretty calm about SpaceX's IG rating and ability to borrow, or from the equity perspective, thinking like, oh my goodness, this is a company where there's not going to be positive cash flow for a very long time, and they're still raising more and more money.
Ed, elsewhere, we learned that Oracle has cut 21,000 jobs in 12 months. That sounds like a lot. Is that a lot for this company that's trying to deal again with lots of spending and in some corners of this market, skeptical investors?
It is a lot, and it's outside of Oracle's historic patterns. So that's about a 13% reduction in workforce over a 12-month period. But the point of the regulatory firing, the story within it is that while Oracle's trying to balance funding data center build out, and we've talked a lot again about them swinging into negative free cash flow because of their capital expenditure commitment, they are outlining in this regulatory filing that AI has helped them internally for efficiency and its operating abilities. Basically, AI has impacted some roles in terms of displacement. So, that was kind of the core key takeaway. But historically, Oracle's kind of spattered little job cuts here and there, even though in aggregate it's a lot. They've never done this kind of big trim in a calendar year. But the filing's worth reading for the AI commentary, really.
Well, now they're replacing labor with capital at a level that maybe we've never seen before. And the question is, does saving a couple billion on jobs, on human jobs, actually make up for the tens of billions or hundreds of billions that they're going to have to invest in compute?
Yeah, so what you're referring to is literally the restructuring cost, right? Which is at almost $2 billion, reflecting the reduction in force of 20,000 jobs. I don't know the answer to that insofar as the capital expenditure outlook is to grow every single year. And so, there's still a workforce of 140,000 people there or thereabouts. Will they continue to cut that? It's an analogous story with Meta, right, where it was like, hold on, does trimming the wage bill stack up against the massive multi-year capex commitment? And really, I don't know that the street's buying that kind of line of view, which is why the emphasis on the impact of AI on jobs is an important story. And it's probably why on the Bloomberg Terminal and .com, so many people are clicking on it this morning.
Ed, thank you very much for that. Looking forward to Bloomberg Tech at 11 a.m. Tech host Ed Ludlow. Now to the Middle East. Brent is holding below $78 a barrel. U.S.-Iran talks are continuing. Iran says that $12 billion in frozen funds could soon be released, with the U.S. also waiving sanctions on Iranian oil exports. President Trump spoke yesterday, saying Iran should use the money only to purchase American goods.
If the sanctions go out, money's going to be put into this country. All that money's coming back in the form of purchases of food, which they desperately need.
Can you ensure that the Iranians won't use profits from oil sales to rebuild their military?
Well, they're not supposed to be doing that, so we'll see. But they're supposed to use money to buy food for their people.
Joining us now is Bloomberg Washington correspondent Tyler Kendall at the White House. Tyler, what is the latest?
Hey, Dani. Well, this is expected to be welcome financial relief for Iran as the country maintains it's not going to let up its leverage when it comes to the Strait of Hormuz. We are watching very closely a meeting happening today between Iran's top negotiators and officials in Oman as the countries released a joint statement earlier today seeming to confirm an intent to release a fee structure related to the Strait of Hormuz for what is being called navigational services after the 60-day ceasefire extension. We did hear President Trump comment on the Strait earlier today in a pair of posts on Truth Social, saying in part that 19 million barrels were able to safely transit through yesterday, and doubled down on this idea that you mentioned, that any unfrozen assets would go towards the purchase of U.S. agricultural goods. Now, Iran is disputing that notion, saying that it will be able to use any of the assets, quote, freely. And we should say that in the actual text of the Memorandum of Understanding, it does stipulate that the Iranian central bank will be able to designate any beneficiaries of these assets. Now, this is all being done, of course, in a bid to try to make progress when it comes to potential curbs on Iran's nuclear program. As President Trump earlier today in a post on Truth Social reiterated something that we heard from the vice president yesterday, that in part, quote, Iran has fully and completely agreed to the highest level of nuclear inspections. But that was something also disputed by Iran's foreign minister earlier today.
Tyler, we also saw President Trump sign executive orders around quantum computing. He was standing with Ruth Porat, the president at Google, and IBM CEO, the IBM CEO Arvind Krishna as well. What's the story with these, I guess, quantum and cyber defense executive orders?
Right. So, Matt, this actually coincides with a push from the administration just last month for $2 billion in investment and taking an equity stake in 9 quantum computing companies. This White House is saying that they're trying to stay at the forefront of competition when it comes to quantum computing. The simplified idea here is that quantum computers, which are capable of solving problems much faster than traditional ones, coincide and complement with the advances that we're seeing in artificial intelligence. One of these orders directs federal agencies to work with the private sector to essentially build a supercomputer that can conduct scientific research by 2028. And the other executive order has to do with bolstering the U.S.'s capabilities when it comes to cyber attacks. It is something that the White House has tried to put forward at the forefront, that this is an area where they can help bolster U.S. national security, but also importantly, Matt and Dani, compete when it comes to China.
All right, Bloomberg's Tyler Kendall there at the White House. Hopefully this technology can also solve the reflecting pool issues. A check on markets right now. We see a sell-off underway. S&P futures down 1.5%. NASDAQ futures down more than 3%. Just less than 20 minutes away from the opening bell. You can see the 10-year yield holding steady at under 450. Brent crude holding steady at under $78 a barrel, but essentially a sell-off that started yesterday and then got hot in Korea is hitting the U.S. again this morning.
Yeah, it's all those chip makers selling off a lot. Elsewhere, FedEx, they released their first earnings after the bell since a spinoff of its freight business earlier this month, somewhat caught up in the market-wide sell-off.
ServiceNow was given an overweight rating by J.P. Morgan with a $145 price target. You can see the shares up 2.5% in the pre-market.
And Netflix bouncing back this morning after hitting its lowest level since 2024 on news yesterday that Meta is exploring TV for social media.
All right, coming up, SpaceX prepares to launch its first in-space manufacturing mission. It's already, I believe, shot some capsules up into the atmosphere as the head of SoftBank says Elon Musk's data center in space ambitions are unrealistic, or at least less useful for winning the AI race. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. The CFA Institute says just 39% of candidates passed the level 1 exam in May. That's down from 45% in February and below the 10-year average as well. Over 31,000 people took the test. It's the largest cohort since before the pandemic, highlighting continued demand for the credential, or just the fact that people have nothing else to do. Goldman Sachs is barreling toward another record-breaking quarter, with equities trading revenue expected to top $5 billion and possibly eclipse its all-time high that was just set 3 months ago. A global AI trading frenzy, booming activity in Asia, and Wall Street buzz around SpaceX's blockbuster IPO are powering the surge. And SoftBank founder Masayoshi Son is rejecting Elon Musk's vision of orbital data centers, saying AI will be won by computing power here on Earth. Son argues electricity is only a small part of data center costs, while launching and maintaining equipment in space would be far more expensive. SoftBank plans to keep investing heavily in terrestrial AI infrastructure for now. Dani saying that the race will be won in the first few years, not decades later.
Well, let's talk more about SpaceX, considering it is in the throes of a multi-day sell-off. Bloomberg chief aviation correspondent Sid Phillip joins us. Sid, it always has sounded like fantasy that we'd get data centers in space. Does Masayoshi Son have a point? I mean, this seems like a really difficult thing to do.
I mean, it is an arms race to get data centers built, and Elon Musk is sort of betting on being able to leverage the multiple sort of strands that SpaceX is sort of following with their space business, with the data center business, and sort of merge them all into this giant data center in space idea. But there are sort of costs associated with transporting things to space, using space infrastructure to power data centers, and electricity is one of the few costs there. So it is one of the challenges for SpaceX to actually sort of prove the viability of data centers in space. And Masayoshi-san, talking to shareholders, talked about how chips will be the sort of biggest stumbling block for data centers, and that's sort of, I mean, SoftBank obviously has a play in that space. So,
I mean, he's talking about the here and now, right?
Exactly.
Chips are the biggest costs, and he's saying that the race will be won in the first few years. And the way I read it, I think he allows for Elon Musk, having the right idea a decade on.
Exactly.
But he says by then, there will already be winners and losers.
Exactly, and sort of the now is the more important part of the AI data center play rather than what happens in a decade from now. And I think that's the key.
By the way, SpaceX, we know, has been able to borrow pretty cheaply in this market. It has an investment grade rating, and there's multiple stories out today, basically with skeptics coming out saying, is it really worth that given, yes, it has access to liquidity, but misses some of the other hallmarks. I go back to Bill Ackman arguing on X that the value of SpaceX is the fact that it's valuable and has a cheap cost of capital. What changes for this company if this sell-off picks up steam?
I mean, for SpaceX, I mean, obviously they're looking to raise more cash. They're looking to sort of scale up their various businesses, and being unable to sort of do that would, and sort of serve people losing faith in the company's ability to actually continue sort of borrowing that cash cheaply and starting deploying it for its various business ventures. That will be something that investors will be looking at to see if it has a continued ability to do that. Just
a minute left here, Sid, but I think SpaceX has already put one of its Starfall capsules into orbit. I think 6:55 this morning they launched one, and they can hold like 2,200 pounds, right? 1 metric ton of stuff in these capsules, and they want to be able to do manufacturing in these capsules and then bring it back to Earth. What are they going to make in these things in space that is going to be beneficial that they couldn't do here on Earth?
So for SpaceX, I mean, they're talking about how the Starfall capsule can be used to manufacture things that need microgravity environments, that need sort of specific sort of pharmaceuticals that need to be manufactured in with those high radiation levels in space. And so they're looking at very specific niches, and they're talking about how these capsules can be reused and cheaply sort of brought back to Earth, and that could also facilitate Earth-to-Earth transportation without having to have any infrastructure in terms of being able to launch in space and bring back to space. So they're looking at various ways of this is a reusable vessel that could be sent to space and brought back to Earth, and various components could be done in space, including sort of using space factories. I mean, it's still unclear what those factories will do, but they're offering that service.
It's pretty fun. All right, it's pretty fun to talk about, but maybe not fun to invest in. You can see SpaceX shares right now down 3%. Bloomberg Chief Aviation Correspondent Sid Phillip, thank you so much for joining us. Coming up, Marija Veitmane talks the sudden shift in sentiment around AI sustainability. This is Bloomberg Open Interest.
When you look at it, the chip names, have done a great deal of the heavy lifting. You will need a refreshed attitude towards the Mag 7. There have been certain periods of time where essentially earnings and price have, caught up to each other, and we think that's one of these periods in these larger names, and that you will have price start to advance.
Evercore's Julian Emanuel on surveillance. Let's bring in State Street Global Markets Head of Equity Research, Marija Veitmane. Marija, great to see you this morning. Look, I wonder if some of the sell-off, specifically in these AI names, goes further than just high valuations. And I present to you evidence A. We have a chart basically tracking the price of tokens and the hyperscalers, and they're almost perfectly tracking each other. As the price of tokens goes down, which is that blue data there, you've seen the hyperscalers in white also drop. I wonder, Marija, are we starting to bump against this idea that what the hyperscalers can charge their customers has kind of reached its zenith, that there is this pushback and it's upsetting the entirety of the AI narrative?
Yeah, hello. And I mean, I'm very glad that in addition to the two lines you kind of talked about, you put the price of semiconductors, which is continue to push higher. So the semi stocks at least are not upset by that trend. But I mean, that's a reality. And we kind of always assumed that at some point the price of tokens will come down. And that was actually for a while a part of the narrative that as kind of AI will get cheaper, more and more clients, customers will come in, and that will push demand. And so I think market kind of picking and choosing its narratives. But I mean, for now, we're still seeing quite a strong institutional investor commitment to the sector. So,
I mean, how much more will we see in this drop? Do you think we could see a correction? Do we need to see a correction? Because I'm sure you're bullish for the year.
Yeah, no, of course, I'm bullish. And I mean, the idea for me about tech sector in general is those stocks are still providing very, very, very strong earnings. And it is earnings corrections that we are looking for in terms of kind of broadening of equity behavior. Can we see other sectors produce stronger earnings? And for quite a few years, the answer was no. Majority of earnings were coming from tech sector. I mean, we're getting closer to earnings season, so we're good 3 weeks away. And still, majority of earnings, I think at least two thirds of earnings growth in Q2 are expected to come from tech sector. Okay, energy is supposed to kind of contribute to growth. We know that, but probably that's the last time last quarters they do it. And everything else is actually really uninspiring. So in a way, do I want to rotate out of tech? Yes, only when you see better earnings, and we're not there yet.
All right, Marija, you're going to stick with us through the opening bell. Marija Veitmane there from State Street. We are looking at a NASDAQ futures drop, NASDAQ 100 futures falling more than 3%. The opening bell on the other side of this break. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at big drops in futures. S&P futures off 1.5%. NASDAQ futures are down more than 3% as a sell-off that spread from the U.S. to Asia and then intensified there comes back to smack us on a Tuesday morning. Ringing the bell at the New York Stock Exchange is Twilio to celebrate its 10th anniversary. Over the last 10 years, the stock is up 422%. So if you got in then, you're good. Over the last 5 years, they've lost about 43% of their value. So hopefully you didn't buy the stock in 2021. GitLab is ringing the bell at the NASDAQ market site. Over the last, since October of 2021, they've lost about 66% of their value. So oof. I'm not sure what they're celebrating there, but
they're allowed. I guess they're still allowed to celebrate even if their stock's down, right?
A group of gits in the lab.
Oh, yes. Is that what a group of nerds is called?
That's a British expression that we don't have here in the U.S. But I think it
I don't even know it, despite living in London for 6 years. I've never heard that. No.
You've never heard someone called a git?
What is it? What is it?
I think it's like a pejorative term.
Okay, cool. Well, don't explain fully what it is. Maybe then. I am looking at the tech sell-off this morning. Matt, you pointed this out, just how poorly the NASDAQ is doing. We've had really big gains, so maybe this is just selling that on the AI trade. Also not helping was that big slide in the Kospi. Today in Korea's exchange, a lot of retail traders and speculators on that. It fell, had a circuit breaker, so NVIDIA, Micron, both down 12.7% for Micron, and SpaceX down for yet another day, now trading, I believe, below the $2 trillion market cap.
Don't worry about Micron.
Why not?
I'm worried. I mean, it's still up. Let's see. Over the past 5 years, Micron is still up 1,254%.
But isn't this still like the pillar of the AI chips trade, and all the earnings upgrades have been because of Micron? So if this thing...
with a 12% drop, it's still up 776% over the past 12 months.
It's pretty good.
So it's done quite well. IBM is among the few big tech stocks, or I guess used to be a big tech stock and hopes that it will one day return to that status. That's up today, gaining 2.5% as it joins the what's called the OpenAI Daybreak Cyber Partner Program.
Of course.
But also JP Morgan out with a slew of upgrades this morning has included Big Blue. That's what we used to call it, Dani, back in the day. Big Blue, because at the time it was like the biggest of blue chip stocks. Now it's worth less than $250 billion.
That's like one day of Tesla trading.
Yeah, I mean, it's worth less than half of Intel.
Wow, that's tough. Well, the president called it out with the CEO at the White House yesterday, so maybe that gives him a boost.
Oh, he likes the stock?
He likes the stock, and he wants to include them in his quantum executive orders. So
cool. Hey, let's bring back in State Street Global Markets head of equity research, Marija Veitmane. Marija, I wanted to ask first about, because you mentioned earnings, and there are a lot of these companies we were talking about. Oracle, for example, replacing labor with capital, firing like 21,000 people, but investing still tens of billions of dollars in the data center build out. We talk about SpaceX a lot, especially over the past couple of weeks, and they're going to be negative free cash flow like as far out as the eye can see, right? A lot of these companies are making no money at all, and yet investors are willing to give them the benefit of the doubt. Like we did with companies laying fiber in the dot-com era, or companies building railroad tracks before even you and I were born. Does that worry you at all?
I mean, on individual company names, absolutely. So there are a few companies, like you mentioned, Matt, that are cash flow negative. But I mean, if you look at tech sector overall, and that's kind of where we are focusing, is that overall, those kind of astronomical capex numbers, they still come mostly from operating cash flow for the sector overall, and probably like half of operating cash flow. So companies have money. It's, I mean, there are some specifics, but overall, I mean, we're not kind of at the same level of kind of spend that compared to operating cash flow as we've seen during bubbles, previous bubbles.
Still, some of these big tech spenders are spending more, and they're seeing their cash flows diminish. I mean, let's take SpaceX as the poster child that has negative free cash flow right now. Looking at SpaceX dropping, you can see it on your screen, down 1.5%, not as bad as right at the open, which was near 4%. Is this indicative to anything to you, the way that SpaceX is trading right now, the fact that it gained like 20% in 2 consecutive days, and then it has started to sell off? Does it say anything about the wider equity market mood, or do you look at this thing with all of the strangeness around supply and demand and kind of put that to one side?
I mean, SpaceX is very, very special case. And I mean, we know that IPO was kind of targeted toward retail investors. So what we do at State Street, we focus on what large institutional investors doing. So that's usually kind of the long-term trend. So that's where the people putting money. And I mean, it's really astonishing that since the start of the war in Iran, tech was the only sector where institutional investors have put money. They increase the size of the benchmark allocation almost threefold, taking money out of every other sector, particularly like healthcare. And actually, it's both cyclical, so it's defensive. So industrials, materials, kind of on cyclical demand destruction. They're taking money out of healthcare and staples and kind of margin compression, and they put all this money into tech. So I think large institutional investors are very kind of supportive of tech sector. SpaceX, obviously, like single stock name and huge retail participation. So I think those two things kind of can coexist.
I love the, I've always loved the term rhino. You know, it used to be Republican in name only. Now almost all Republicans are rhinos. But you say rally in name only because it's been completely powered and totally concentrated by the, I guess, IT or hyperscalers components of the index since the beginning of the war in Iran. Do you see that turning around? Because we talk about this rotation all the time. Is it actually happening?
Yeah, I mean, as I was saying, this rotation, and thank you very much for picking up Rhino. I think that's a funny acronym. But in terms of rotation, what you need for the rotation, you need better earnings somewhere else. So I keep kind of hammering this message is, where do I see earnings? I 100% agree with anyone who will say that tech is expensive and tech is very, very crowded. But for now, we don't have better place to put money in. When, I mean, yield curve is flattening, not great to buy financials. Margins are getting squeezed, not great to buy staples and healthcare. Industrial kind of complex is struggling with demand destruction. So it is very, very difficult to find somewhere else to put money. And overall, there are plenty of money still around the system. Liquidity is ample, and they're all going into tech sector. So that's your kind of definition of rhinos. That's money going. All the money that they are going to through very narrow bottleneck. And I think that creates conditions for the days like we're seeing right now is that, okay, there is volatility in the market because those positions are really extended, because returns have been astronomical. So people taking profits, people readjusting. But until we see a better place to put money in, I think we'll have those very concentrated portfolios in tech sector.
Relatedly, and I hate to pick on him because he's not here to defend himself, but Phil Camporelli of JP Morgan Wealth was on both Surveillance and Surveillance Radio earlier. And on radio, I heard him say something like, understanding the consumer right now is so important. If you understand the consumer, you can get your portfolio right. Marija, I just wonder, given what you're saying, is the consumer really as important anymore for markets? Again, we're in this day and age where the rally all feels based on AI. So can we kind of ignore the health of the consumer right now?
I mean, I don't want to be caught on record saying you don't have to pay to pay attention to consumer, but stock market is driven by very, very large companies who cater for like very kind of higher end businesses and consumers. So that's kind of the wealth effect where it is, and that's what's powering the earnings at the moment. So yes, consumers, there are areas where consumer is struggling, and it's really detrimental for those companies. I mean, my favorite example is BMW, one of the better European companies, has slashed its guidance on margins to 1%. So yes, demand is important, but is it important for the overall market level? Probably not, but for concentration, absolutely.
All right, Marija, thank you very much. That's State Street Global Head of Equity Research, Marija Veitmane. Always a pleasure to have you on. About 10 minutes into your cash equity trade, let's get a check on markets, and they are decisively lower, down 1.4%. It's even worse if you look at the NASDAQ. The good news is Mag 7 has spent yesterday, and a lot of this year, to be fair, selling off while the entirety of the index has been doing better, but you get a little bit of a reprieve on that today. So it's kind of just a momentum sell-off and a momentum flip today, that you get Microsoft doing well, which has been the worst performer, I believe, in the Mag 7. Amazon and Meta also having good days. Walmart is up there, has a new deal over nuclear energy. And IBM, Matt mentioned this, they get an upgrade from JP Morgan and a call out from the president. On the downside, we're flipping back and forth between what's the bigger drag to this index, between NVIDIA and Micron. Both are subtracting at least 18 points from the S&P 500, which is down 101 points so far today. And then the rest, it's all the chip stocks. AMD, Lam Research, Applied Materials, SanDisk, Tesla's in here, which is SpaceX is not in the S&P, so I guess sell Tesla if you're part of that. Again, carrying on from that really, really ugly sell-off in South Korea. So Infotech down decisively because of that. Will Micron earnings save us on Wednesday? That remains yet to be seen. So again, it's a flip of what you usually see. Staples, healthcare, real estate doing well, when usually staples are the less loved sector, along with healthcare, Matt.
That's interesting, and that's a snapshot of the industry groups moving around today. Marija Veitmane was talking about her new acronym, Rhino, rally in name only. And so I pulled up the relative rotation graph on the Bloomberg terminal. I've put it behind you. Beautiful. Check it out. So this is one of those, the business matrix that you learn about in, Econ 101 or whatever. And so you've got your cash cows and your dogs and your shooting stars. And just look, over the last 12 weeks, which is what I've got here, IT is really the only one that's gone from improving into leading. Everybody else is going from weakening to lagging.
Yeah, so that's that green arrow right here. This is the Infotech. And everything else looks bad. Energy is down there, healthcare, utilities, consumer, financials. Everything looks bad, even financials, despite the fact Goldman Sachs just reporting, we're reporting that they're likely to get another record equity haul, and they had a really big deals haul. You talked about that too, so interesting financials. Can't keep track. Yeah,
I just love the RRG screen on the Bloomberg terminal. Coming up, the chip rally takes a turn as investors around the world lock in recent gains and reassess the sustainability of the AI trade. Mandeep Singh joins us next. He runs our tech coverage at BI. This is Bloomberg OI, Open Interest.
All All right, let's get you some top calls and hear from the sell side this morning. First up, Wolf Research. They've upgraded Target and name it a top pick. They say execution is improving with new management. That's changing the playbook. And store resets help make Target a destination again. Shares up 3%. I've always loved Target, always been a destination for me. Nike also getting downgraded by Evercore. They say the turnaround is still running into problems. There's a weak innovation pipeline, apparently, execution issues, warning that Nike may need to cut expectations again as business trends remain under pressure. And IBM, they get a boost after JP Morgan has upgraded the stock. That is JP Morgan, though, not IBM.
JP Morgan is down.
JP Morgan is decidedly down. If we were looking at IBM, you'd see that IBM shares are up because not only did they get a JP Morgan upgrade, but
4%.
They also 4%. There you go. IBM up 4%, and they've also joined an open AI partnership program, basically a cybersecurity initiative focused on AI-powered threat detection.
Let's look briefly at IBM. Yes, in the screen behind you also, but I want to talk about the stock just briefly with Bloomberg Intelligence head of global tech coverage, Mandeep Singh. Just to reminisce about Big Blue, Mandeep, back when it was one of the most important chip stocks, one of the most important stocks at all on the Dow, right? When the Dow mattered so much. Is there going to be an IBM renaissance? Can it come back? I mean, it's only worth $250 million, which today it's like almost a third of Intel. So,
I mean, it feels
$250 billion. Sorry.
It feels like they are positioning themselves for, both participating in this AI growth, which they're not at the infrastructure level, more at the application level, and also with quantum, they're trying to get there early in terms of establishing their leadership and, being among the early players to scale this up. I just feel when it comes to infrastructure, we're still so early with quantum. And given the amount of spend we are talking about, with that AI infrastructure build out, I just can't be bullish on, quantum, at least for the next 2-3 years.
And I also feel like every day there's new quantum IPO or like something out there, which okay, everybody slow your roll.
The scale is so different.
I gotta say, they're in Armonk, New York, right? So I ride up there all the time, and I will stop at the cafes and chat with engineers who were working on large language models 5 years ago. They have labs on the frontier. Yeah. Why haven't they been a bigger beneficiary of the AI craze?
Well, right now, I look at the Google news over the past couple of days. They have lost 2 of their top, scientists when it comes to training these models, and the market cap dropped $250 billion. So that's what we are talking about in terms of, companies losing talent to Anthropic or OpenAI, which seem to be getting the top talent right now, and I would say the same holds for IBM as well.
I was reading a Torsten Slok of Apollo note today that basically laid out 3 macro risks. One of them was around AI and what happens if companies start to limit their token spend or shift meaningfully to some of the open source or Chinese models. There's also an information story that says just that. Companies are starting to switch to the DeepSeeks of the world. We also have a chart basically showing that token prices have started to fall and the hyperscalers are tracking them. Is it more than just a risk? Is this something that's truly playing out right now?
I look at this based on use cases. And to my mind, companies that are at the frontier, like Anthropic, they grew their revenue 5x year to date for a reason, because their model's output is far better than even the Geminis and the Metas of the world. Forget about the open source models. So to my mind, people are willing to pay up for the frontier models if they know the use case, which in this case is coding agent or something to do with document reviews. But if you're experimenting with stuff, yeah.
But isn't Microsoft trying to switch to DeepSeek?
Well, Microsoft has a different equation altogether. They rely too much on OpenAI. Now OpenAI has gone to Amazon, so they have to figure out how to run Azure in a way where it's not, hurting their gross margin. So Microsoft will support all the models. But in the end, it's the customer who is deciding, do I really want the frontier model, or am I okay using open source with that China aspect, which presents its own security risk? So I'm still not in that camp where you can scale open source in a big way over the near term.
All right, Mandeep, thank you so much for joining us. Always great to have you. Bloomberg Intelligence Head of Global Tech Coverage, Mandeep Singh. Coming up, the yen hasn't been this weak since 1986. More on the possibility of government intervention. That's coming up next. You're watching Open Interest. Currency traders are on intervention watch after the yen weakened to its lowest level in 40 years. Japan's finance minister said she spoke with Treasury Secretary Scott Bessent, and they agreed that bold action may be needed. Here with more is Bloomberg's Enda Current in Washington, D.C. Enda, do the signs point to some sort of intervention by the MOF?
Well, it sounds like it, Dani. As you mentioned there, the Japanese finance minister overnight making the point that she spoke with her U.S. counterpart, Treasury Secretary Bessent, and she said they're talking about bold moves and how they're both aligned on what actions they might take. Now, the issue is that the yen is under so much pressure because of there's a perception the Bank of Japan isn't raising interest rates fast enough. And, of course, the oil price is also weighing on the yen there, too. We did have some action with the BOJ earlier this year. If you remember, there was that price-checking exercise where they were calling around with some support from the US side on that. There was some reaction to the yen then, but the bigger picture, I think a lot of, in terms of reaction I've seen, Dani, is people are asking, even if Japan does intervene, how effective might it be, given the issue here is dollar strength, and that doesn't seem to be going away anytime soon.
So, I mean, how much, Enda, roughly will the Japanese spend on intervention? Like, what do they spend every few months to support the currency? And, I mean, are they actually trying to reverse the drop or just slow it down?
Well, it's probably more about, typically speaking, finance ministers, Matt, only want to get involved in the currency market if it's disorderly, sell-off, or if it's volatile. It's not necessarily about reversing the trend per se, and I doubt that's what Japan is trying to do here either. I don't know the exact figure that in terms of what they will spend, but typically speaking, they do spend in the tens of billions trying to put a floor under it. But as I mentioned a few moments ago, I think the bigger question is, the perception is that the BOJ isn't raising interest rates fast enough. Intervention won't change that. And then on the other side, you have the dollar strength being where it is. That seems to be on something of a stable trajectory. We had that hawkish tilt from the Fed last week. That doesn't lean into a weaker dollar in the near term either. So there's a lot of skepticism from the reaction I've seen this morning questioning, OK, Japan might go in, they might try and buy their own currency and sell dollars, but people aren't convinced in terms of how long-lasting that might be.
What about the BOJ? Might they push forward a rate hike, Enda, given what's happening to the currency?
Well, they seem to be taking it, one step at a time. The currency is the purview of the Ministry of Finance in Tokyo, in the same way that the Treasury here has the call on the dollar rather than the Fed. So it's not clear if the BOJ would react just to respond to what's happening in FX markets. But I think there is a view that the Bank of Japan seems to be taking things quite slowly, quite cautiously there. More rate hikes are expected in Japan, of course. It's a question of whether or not that's enough to try and to change the perception among currency traders.
All right, Enda, thanks very much. Bloomberg's Enda Curran talking to us about the yen right now trading 161.53 is how much yen you could buy for $1. So getting near as damn it to the lowest level the Japanese has traded at in many, many years. I think the low was almost 162 in 2024. Check on the broader markets. S&P 500 off 1%, a little bit more. NASDAQ falling more than 2.5% right now as Treasuries and Brent hold pretty tight. You can see the Sachs index there as well, down 6.2%. Coming up in the next hour, Amanda Agati on the extraordinary run for chip stocks since late March and the sell-off that we're looking at today. Plus, Oklo's Jake DeWitte discusses the fuel needed to run their reactors as part of a new deal with Centrus Energy in the great state of Ohio. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. A chip sell-off worsens as we head into later within the U.S. trade.
Yeah, we will talk about that in this hour. From Seoul to Wall Street, global stocks get an AI reality check as tech shares slide again.
And then there's SpaceX, too, also posting losses earlier, now turns to gains, defending that $2 trillion valuation.
Plus, America's nuclear renaissance, or hopes for one. We'll hear from Oklo CEO Jake take DeWitte as the Trump administration ramps up support for new, smaller, modular reactors.
We begin, though, with tech dragging down markets globally. The rally since late March has slowed this month as investors worry about share prices overheating. Bloomberg's Carmen Reineke covers equities and joins us at the desk. Carmen, what is just the anatomy of this sell-off? Because it feels like it began with a very local specific story about SK Hynix and has really just bled into the American session.
Yeah, it's such a good point. So basically we saw the Kospi falling this morning after SK Hynix and Samsung, shares specifically sold off. There was a local media report that SK Hynix might be sort of slowing production of a specific kind of memory chip that's really important in AI data centers. That sent those shares lower and sort of sparked this global sell-off in these chip stocks, with specifically the memory makers leading the route lower. So today we have SanDisk, Western Digital, Micron. All of those stocks are the heaviest lags on the S&P 500 right now. So it really sort of spun out from that. And we're going to get more news coming up in the week. So Micron actually reports earnings after market close on Wednesday. So I think that'll be a really key moment to hear sort of what they're saying about demand as they see it.
Yeah, absolutely huge. I mean, Dani keeps showing this chart today, illustrating the drop in token costs, but we see the rise in the Sachs index, right? And at some point, we know that these hyperscalers are subsidizing AI usage. I don't know what analogy to use. The rooster will come home to, I don't know. But at some point.
Comes home to roost.
Yes, the chickens. In any case, at some point, we're going to realize, investors are going to realize that someone has to pay for all of this, right?
Yeah, and there's real worries about cyclicality in this space, especially in memory makers, because what often happens in this sector is that there's demand all of a sudden. All these places sort of ramp up their CapEx to have the supply to meet the demand, which is something that we're seeing now, especially because these hyperscalers are spending so much money for memory chips. And then that leads to a glut, right? And so as the supply then is too much, demand falls, and then we're left sort of on the other side of the equation with share prices falling.
All right, Carmen, thanks so much for joining us. Bloomberg's Carmen Reineke covers the stock market for us. Joining us now is PNC Asset Management Chief Investment Officer Amanda Agati. And Amanda, let me just first get your take on this sell-off. I don't know if I'd use the word severe, but you don't often see the NASDAQ 100 falling 2.5% in a day, the Sachs index more than 6%. Is it just that we've come so far, so high, so fast?
Well, I'm still giggling about your chickens and roosters analogy. I think there's something to that as it relates to investor sentiment. I've been using song analogies for years. So my version of that is Paranoid Android by Radiohead in terms of investor sentiment. I think that's entirely what's going on here. The Philly Sox is up 100%, right? Since the end of the first quarter. I'm a Philly girl. I like to talk about the Sox, but it's gotten way ahead of itself, right? This has been entirely a Mo trade. And so the question is, when are the fundamentals going to catch up? And so I think, the minute a negative headline, even if it's a small one, comes into the equation, when investor expectations are so high and valuations are starting to get stretched, it just doesn't leave a lot of headroom. So this feels natural and healthy to get a little bit of a reset here after just an extraordinary run.
Is it all just momentum, Amanda? Because let's take Micron, which is going to be reporting earnings on Wednesday. It's seen stunning earnings growth expectations. I think since April 1st, the statistic is like 11% upgrades from the sell side, which more than doubles what the S&P expectations are. Isn't there some fundamental story to just how earnings are really solid among these chip makers?
Oh, absolutely. Q1 earnings season was just absolutely tremendous in terms of shooting the lights out relative to expectations. So there is a ton of fundamental strength there. But I think because investors have this anxiety around what the path forward holds, what the right forward PE is, what the winners and losers may be, I think everything's kind of selling off here. Investors aren't as discerning maybe yet as they should be as it relates to the leaders and the laggards. And I think that's just what's happening here in the short run.
This is all about bottlenecks, and we talk about energy usage, right? We talk about memory, chips. These have been incredible investments from Micron to Oklo. What's the next bottleneck? Or do you spend time, Amanda, actually thinking about looking for the next bottleneck here?
Well, I don't know that I want to call out the specific bottlenecks and the investment opportunities that we see right ahead of us here, but you're absolutely right to say that demand has far and away exceeded supply, and these suppliers are just trying to catch up, and so pricing has been through the roof, right? Because things have been so constrained. I still think demand, it certainly is a function of what we heard out of Q1 earnings season. Demand just continues to skyrocket here. I think the challenge from here is pricing, how to stay competitive in the AI innovation cycle. Just the bar keeps getting set higher and higher. And so I think it's less about what the bottleneck is in terms of the next handoff, in terms of this innovation cycle, and just the cost or the expense that investors are willing to accept at this still early to kind of middle innings of the cycle.
Also, along the lines of cost is the cost of AI. It's something Matt and I have been talking about nonstop because it is such an important narrative that's been forming. I mentioned this to Mandeep earlier, this Torsten Slok from Apollo note, laying out 3 macro risks. And one of those macro risks is around AI and token costs, that you get companies who push back and say, we're not willing to spend as much as we currently are, that they move to open source models, that they just limit the amount that employees can spend. Amanda, is there a situation that we could see demand meaningfully pull back because company business models gets challenged just because of how expensive it is to run some of this stuff?
I think there's going to be winners and losers as it relates to who uses tokens, what the right business model is it open source, is it one enterprise-wide license, and you can use it as much or as little as you want. So I absolutely think that there are going to be winners and losers. I don't think that the revenue streams have really been clearly defined at this point, neither of the use cases. This is a lot of the disruption that happens in the early to middle innings of an innovation cycle. So I'm not at all surprised to see the noise around this. I find it very hard to believe that demand is going to dry up here in this environment. This is a race. Everybody's trying to figure out how to win the race, and everybody feels perpetually behind. So I don't see the demand story slowing. I just think it's more about what the business model is that ultimately takes the lead.
Yeah, I mean, this is the discussion that Masayoshi Son is having, I mean, not with Elon Musk directly, but that we're reading about in the press today, right? Son says the race is going to be won with compute here on Earth because it will be won in the first couple of years of this AI revolution, whereas he says Musk is betting on, technology a decade or 2 ahead, where we're going to have compute in space, which currently would be far too costly to even really conceive of, although Elon Musk can conceive of almost anything. How do you think that plays out?
Well, it's a great question. I wish I had an answer. It's sort of like the billion-dollar question. I think both win, which probably feels like a cop-out, and I don't mean it to be, but I think there are winners in the short run, and then I think those who can really think creatively about the long-run trajectory of growth, AI innovation, adoption, et cetera, I think they win in the long term too. It's just, I think investors have a hard time getting really creative in the short run, and investors are also really impatient, right? We focus, I'll include myself, we focus on quarter by quarter results. What about 10 years from now? It's really hard to envision what that looks like based on where we are today. But I think both can win. You just have to be in the game to win.
To take you even more short term, just SpaceX today, we're looking at the price. It's up 1.7%. At one point, it was up 2.8%. At one point at the open, it was down nearly 5%. And trading has only happened for an hour and a half. Amanda, what does it mean to have this new IPO with so much hype and so much retail money behind it and worth $2 trillion, just to be seeing the type of volatility that we are in these early days?
I'm not at all surprised to see the volatility. This is a joke, so no one should freak out. But I always say IPO means it's probably overpriced. And I think, we haven't seen, I'm giggling just because it's a fun thing to talk about. There's not a sell on SpaceX, for goodness sakes. But I think investors are struggling with this one, given the 3 very different businesses under this sort of conglomerate umbrella, and what's really going to be the needle mover going forward. And so this is exactly why I said I think investors struggle with creativity and sort of seeing the future. It isn't that we don't want this type of activity to occur. I think we've had a real drought in terms of capital markets activity. I think it's a great signal for the health of capital markets coming flooding back in. So we'll expect to see more IPOs going forward. But I'm not at all surprised to see the volatility. This is kind of like exactly what we would expect to see, particularly with an IPO of this size.
That's why the NASDAQ has moved to put SpaceX in the index within 15 days, because they want that kind of volatility in a massive $1 trillion stock on the NASDAQ 100. What likelihood is there, and I know you said it's a joke, that SpaceX, OpenAI, Anthropic, that these IPOs mark a top here? Are we going to look back in 5 or 10 years and say, of course, that was the top?
Well, it's always a great question. It's always a question that investors are focused on. As soon as you start seeing a glut of IPOs, is that the peak? Is everybody cashing out? I don't view it that way at all. I think, again, if we had been on a tear from capital markets activity over the last, let's call it 3 years, I might be feeling differently about it. But I think there's just such a frenzy because we haven't had this kind of activity in so long that that's just really bidding up the prices and the activity in this environment. I don't view it as a peak. We're still very much in the early to middle innings camp of all things AI. I think it's just sort of the next stage in the maturation of the cycle. But I do worry a little bit about the underlying cost, right? The return on invested capital is going to look a lot different with debt issuance, equity issuance, et cetera, relative to free cash flow funded projects here. So I think it is definitely changing the nature of the next phase of the cycle.
Amanda, we're going to have to leave it there. Thank you so much for joining us. That's PNC Asset Management Chief Investment Officer Amanda Agati. Let's get a check on your equity market about 40 minutes into your trading day, and it continues to be pain in tech stocks and chip stocks that are leading this market lower, with the NASDAQ underperforming, down 2 1/3%, the S&P down less than 1%. SpaceX now gaining because why not? It was down as much as, I think, 4% at the open. So it's been really volatile, but it goes back above $2 trillion. So congratulations, SpaceX, for not going under there. And Brent crude, that continues to fall down 1.5%.
All right, let's take a look at some of the single stock stories we're following for you at this hour. IBM has joined this is the name of the program, OpenAI Daybreak Cyber Partner Program.
Yeah, of course.
It also got an upgrade from JP Morgan, and Big Blue is up 4% in Armach.
Carnival, they reported a weak third quarter outlook. That means that all cruise stocks are selling off, led by Carnival, down 6%.
Avis getting maybe a boost as it settles with Pentwater Capital over a short squeeze. You can see it's up 5% in the early trade.
Pentwater is going to have to pay them $650 million. Coming up, Apollo gates its flagship private credit fund. Broader concerns about the asset class persist. This is Bloomberg Open Interest.
Let's get to high interest now. Look what's making headlines around the world. Goldman Sachs is barreling towards another record-breaking quarter, with equities trading revenue expected to top $5 billion and possibly eclipse the all-time high that it set just 3 months ago. A global AI trading frenzy, booming activity in Asia, and Wall Street buzz around SpaceX's blockbuster IPO are some of the things that are powering this surge. Meta, meanwhile, is expanding its smart glasses lineup with new in-house branded models starting at $299, undercutting its Ray-Ban smart glasses by $80. The company also unveiled a Kylie Jenner edition aimed at younger consumers as Meta pushes to broaden adoption ahead of Apple's expected entry into the category next year. Hopefully they at some point get vertical video, because I don't know what to do with the horizontal stuff. Hong Kong hedge fund Ovada Capital is shutting down as founder James Chen and most of his 40-person team join Exodus Point Capital. The move brings Ovada's $1.5 billion platform and Asia equities expertise to the $14.5 billion multi-strat giant, highlighting how top talent is migrating from smaller hedge funds to industry heavyweights. Dani?
Yeah, it's those hot pod shops everyone wants to join. Elsewhere in asset management, turning to private capital, Apollo once again capping its withdrawals from its largest non-traded private credit fund, its BDC, for retail investors. The firm limiting withdrawals to 5%. Investors, though, had asked to redeem almost 17%. But this should maybe be no surprise. Apollo President Jim Selter said at a conference a month ago, I would suspect a maintenance of the levels of the past, maybe even a little bit of an increase if people want to game the system. Joining us now is Bloomberg senior reporter Silas Brown. Silas, is that all this is? People trying to game the system and time their withdrawals to jump to the front of the queue and ask for more money out?
Well, I think the most notable thing in the second quarter is we're starting to see what's really going on here, which is that the leading private credit players, the ones that have benefited most from the rise of interest from retail customers, are the ones that are most vulnerable in this moment of angst. And so you see Apollo, the likes of Apollo, Blackstone, Cliffwater, the ones that have really kind of generated the most amount of interest among retail, they're the ones that have attracted the hot money. And actually the smaller BDCs have had much more limited redemption or like much more limited outflows from that segment. And I think that kind of dynamic is playing out quite neatly in the second quarter so far.
This is a story by Laura Benitez and Olivia Fishlow, and it's well done. But I wonder at some point, do we just flash a headline and put out a BFW when redemptions are higher than the 5% where they're gated? Because this is just going to keep happening, right?
Yeah, I mean, I think I speak on behalf of many of the print journalists. I think maybe we would be spending our time best spent elsewhere if we did that. Yeah, like, look, I think and the thing also to note with the second quarter, and the reason why I wasn't necessarily bowled over in terms of surprise as to the numbers now, is that the redemptions that are occurring now, people were trying to redeem their capital right at the height of the kind of angst around software and AI, say 2 or 3 months ago. And so I think it's totally understandable that there will be a kind of elevated amount of redemptions this quarter. I think next quarter is the one to watch, because if they keep on creeping higher, that I think becomes much more of a sort of systemic problem, although there's no evidence to suggest that that's the case so far.
It is pretty remarkable to look, though, at all these shares selling off. I mean, that's Ares right there that's falling on this. It's Apollo that's falling on this. And they love to talk about, Silas, this idea that this is such a small sliver of the entire universe of what they manage. Is that the case for all of these private capital giants? Are there any in particular that are quite exposed to retail money flooding out?
Which are less exposed or more exposed?
Or, I mean, I suppose more exposed, because all these giants argue that they're not that exposed.
Well, yeah, I know. I mean, I know. I mean, it's very much in their interest to kind of downplay the level of retail cash that they have at the moment. And I think to a certain, places like Apollo, it is a kind of very small portion of their asset base. Other firms like Blue Owl that have kind of risen much later in the day, I mean, are more dependent on retail cash. So yeah, I mean, I think people are trying to have firmly established now what I think they've always known, which is retail is flightier than institutional. And I think when we speak to fund managers, and I'm sure Dani, you have the same conversations, like they still say that institutional capital is kind of flowing through into the market, and it's more business as usual on that segment. The retail, and particularly the kind of hot money retail, accounts from parts of Asia, but also kind of accounts through the RIA community within the US. I think they're the ones that are most that are kind of most capricious when it comes to private credit.
Silas, from now on, when we see double-digit redemptions, but they're capped at 5%, we're just going to do it in movers, and we'll come to you only if that changes. Yeah. Bloomberg's Silas Brown, senior reporter who covers private credit. Is that fair? Is that fair to do that?
Well, yeah, no, it's fair. It is fair to do that. I think that's
next time there's 15% redemption requests or 19% redemption requests, and they're capped at 5%.
Unless all of a sudden, like Apollo or Blackstone or something changes their mind, they're like, oh, we're going to meet all these or something.
Yes, for sure. Yeah. If it changes, but
what if this is like a year from now and it's still the same thing? I think that's notable, right? That like the pressure's still on, but maybe
then we'll start doing it again for every
Then we
story.
can do it again, but maybe we wait like a year and see what happens.
Still ahead, we're going to talk about powering the AI build-out. Oklo CEO Jake DeWitte joins us to talk about the company's latest deal to secure fuel, and we'll talk to him about when they're going to put these things to actual work at real-life data centers. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what's going on in today's sell-off. We do see a drop of now only 0.75% on the S&P 500, so 74.17, the level there. The NASDAQ down back under 30,000 at 29,694, a drop of 2.2%. It's been worse, right? We were down at one point more than 3% on the NASDAQ. The yen is interesting to watch. Right now unchanged, but at 161.58. It's near the weakest level that we've seen it since 2024. Let's take a look at some of the stocks. NVIDIA down 2.7%. That hurts. But SpaceX is back up. It had been down below the $150 first price from last Friday, from 2 Fridays ago, and now it's back up. Micron is down 8%, which sounds like a lot, but it's up 800% in 12 months. IBM gaining as it joins an OpenAI program and gets an upgrade from JP Morgan. And then you can see these other memory chip stocks down. SanDisk off 10%, but it's up. Dani, what was it, like 5,000% in 5 years?
Yeah, like 4,700%.
Just massive, massive gains. I mean, that's the story here, right? So we're taking little drops from massive gains. We come back, we're going to talk about power. The Trump administration making a major bet on nukes. The Wall Street Journal reporting the Trump administration is preparing $17.5 billion in financing for new reactor projects as electricity demand surges. The energy sector, Chris Wright, says the loans are part of President Trump's plan to unleash the next American nuclear renaissance. Joining us now is Jake DeWitte, co-founder and CEO of Oklo, which just announced a new deal to secure domestic nuclear fuel. He joins us from Oklo's Groves Isotope Test Facility in Lockhart, Texas. Jake, great to have you on the program. Let me ask about this financing funding. I don't know the details of it, but I guess the general story is the administration, the U.S. administration, is behind your industry. How much will it help?
Yeah, thank you for having me, Matt. It's a huge deal, right? What this shows is a continued evolution of support driving for new nuclear deployment to go faster and to happen at a broader scale in the country. So it's a big deal, just another example of this country's, under this administration's, commitment to driving nuclear forward at a faster pace than people thought possible.
It isn't part of this deal, though. It's going exclusively to Westinghouse. So these are like big, giant reactors, which is something different than Oklo does. Does this not create a competitive disadvantage for you, Jake, that if we find, ways to kind of de-risk the traditional massive reactors, that it makes your proposition less attractive?
Yeah, no, that's actually a good question. This is the thing I think about. The opportunity space here is so massive in terms of what's needed for new generation. Like, we're so far behind in new power generation in this country that we need a lot of new nuclear reactors. And I'm very ambitious and very audacious about what we can do, but it's going to take a lot more than even just we're going to be able to do. There's so much room for so many folks to succeed. But here's the other thing people forget about. Every reactor that gets built is a celebration for us in Oklo, because the business we're building is not just about the power reactors. It's about the things that support them as well, including on the back end, including on the used fuel management side, right? We're driving forward used fuel recycling, which is a hugely important part of how the nuclear life cycles are going to develop in this country. So, for example, the facility we announced in Tennessee that we're proceeding on building, that would be designed to be able to take, for example, some of the fuel coming out of these AP1000s that will get built. They produce a lot of great clean power that's really important for the country. But then we help solve the back end on the fuel side. We help recycle the fuel, change its waste form, easier for disposition, and make fuel for our reactors, as well as some isotopes that we can sell off of as co-products. So actually, all of these things are successes that we get to bolt onto in some meaningful way.
So your big product, or the one that I read about most, is Aurora, right? 75 megawatt generally reactors, and you'll supply, I guess if I need like 500 megawatts of power, then I go and buy like 10 of these from you, so I have a little bit of headroom, right? What about the deep fission idea where you'll dig a mile underground, put the reactor core down there, and then just use the water column as natural containment? How far along is that progressing?
I mean, there's a lot of exciting innovation going on in this space, which is cool. I think the big thing that we're going to see is how do we actually get to executing, building, and operating these plants? And then what does that look like in terms of the things you have to solve to scale here? It's a lot more than just the concept and a lot more than just the idea, right? It's about how do you build the full stack to deliver? How do you build out the capabilities to design, to develop land, to actually connect to the grid, to actually build these plants, to source things? All of that kind of consolidates to what I think of as the big three risks that have existed around commercializing new nuclear and scaling: fuel supply, capital, and regulatory. And the things we're seeing happen now, including the deal we announced in Ohio, by the way, last week, is touching in to solving on the fuel side. That was one of the biggest blocks that existed. That's a huge thing. So we announced with Centrus one of the first of its kind deals to offtake significant amounts of enriched fuel made in America for our reactors. Couple that with progress in financing, obviously having listed and being able to tap into the capital markets, we're very well positioned there. That's been huge to allow us to not just build the reactor I'm standing in now, that we're excited and eager to be able to turn on, hopefully very soon, but also on top of that, the ability on the regulatory side, which continues to make progress and is iterating. But with those three things that have been changed under sort of the, frankly, continuation of support going back several administrations through this one, we're seeing new nuclear ideas and innovations be able to start to build and flourish, not just be talked about on paper, but actually get built, just like I'm standing in.
No, I mean, it's getting real, right? We had a story about a smaller modular reactor builder that reached criticality. So it actually had achieved this nuclear, sort of a self-perpetuating nuclear reaction, as far as I understand it. How close are you, you talk about the deal you made in Ohio with Centrus, how close are you to actually turning on one of your, I think, much larger modular reactors at a real data center and really providing power? Are we looking at 2 years out, 3 years out? How far away is it?
Yeah, 2 years out to produce power meaningfully for a data center. We're moving really fast in that pace in Idaho. But what's important about Oklo is we have a lot of things we're doing in parallel. We're solving not just to build one. That's why that fuel deal is really important to solve to build a lot in Ohio to support our deal with Meta. On top of that, we have an isotope business that bolts naturally onto what we're doing in fuel and reactors. And that's where I'm standing today in Texas. This, of all the reactor pilot programs, which is exciting, this is the one that was built on private land. It was full civil infrastructure, involved excavating, digging a 60-foot deep hole, placing in the concrete. It's a major build. We did this in less than a year, and it was commercially sourced on everything we had. And when you think about what the executive orders that were signed that said, hey, let's get 3 reactors to go critical by July 4th on, off national laboratories, this is one of the only ones that can actually satisfy that. And it's actually the demonstration of the full stack. We're not using government fuel, government materials, government buildings, which everyone else is doing. It's good. It's good to get many going, which is important. But this is the only one that's the full stack demonstration of what it looks like to go from just a field to a built reactor. That's what I'm standing in. Right behind me is a vessel that very soon will fill with fuel and coolant, be able to turn on. And it's a full civil build that's meaningful, right, in its capacity. So I think this is one of the really exciting things. This happens first before the power generation side. It opens up the isotope business first, which is valuable, but also positions us really well to take the lessons learned here and bring them forward to our Idaho plant, and then our Ohio plants, and then the future plants we intend to build after that.
We have seen some of your competitors, some of your peers really push forward. Valor Atomics, for example, has reached the threshold of criticality, which is important in getting actual deployment of nuclear power. The White House has said that they want 3 to reach that level by July 4th. That's approaching pretty quickly. That's like a week and a half away, Jake. Can you get there?
Yes, I mean, here's where we are. This building, this facility is ready. Again, an important thing. The executive orders actually said 3 to reach criticality that are not on national lab land. The one already was on national lab land, the first one to go, which makes sense. And big congratulations to everyone there. Valor did it off, which was huge, so very exciting for them. And here we are. But what we did is a full civil construction build, fully commercially procured everything. No government fuel, no government operators, no government land, no government buildings and equipment. It's our facility. So we're ready and we're eager. And right now we're seeing all the things align to see there's a pathway to hit that. It's a hard job to do when you're doing it that way, right? It's a lot easier when you're doing it in a government facilities and government land where things are a bit easier. But we're eagerly working with our DOE counterparts and trying to get this set up to go online and go live as quickly as reasonably possible. So got a good shot. We're going to try for it. It's going to be close, though.
Let me just ask again, going back to the top, about the size of this market, because maybe some money is earmarked for the big, reactor builders. Maybe some data centers are going to say, hey, I'd rather go with a giant gas turbine, or, natural gas is the way to go. But it's a huge market, right? And it's going to need all power sources. How big is this market? Can you put that into context for us?
I mean, when I think about it, the executive orders and the vision that this administration has had that builds on the prior administration's work, we're talking about several hundred gigawatts of new nuclear capacity by 2050. That's like a tripling to a quadrupling of what we have now. And by some estimates, that might be soft. That is huge growth potential when you're talking about tripling or quadrupling what we already have now. And what we're seeing is the hyperscalers are stepping up, and the deals that they've leaned into first have been with advanced reactor companies, small reactor types, but small advanced reactors, like us with Meta, like some of our peers with AWS and Google. That is showing clearly an interest there, but they need so much power so quickly that they're going to be scattering around. And the nice thing about our size set, and this is why we found some traction, we can build out incrementally as they grow their needs. And that allows a lot more, I would say, agility and flexibility and how they can then scale and deploy where they need to go to, where we're building, without kind of having to circle up a bunch of subscription to then deploy after a multi-year build cycle and a multi-billion-dollar asset, a single gigawatt. It allows us to kind of ramp into that more granularly, and then diversify some of the offtakes accordingly, if that makes sense, or concentrate them if that makes sense. But yeah, the market space here is incredibly large. But a key thing a lot of folks don't always appreciate about Oklo, power reactors, big part of the business. But it's the stack we're building around that also allows us to support others, right? Including, for example, on the recycling side. We're very excited about every new nuclear power plant getting built. The used fuel that produces is actually a really important asset for us that we can recycle, and we help them, even if it's not our reactor. So it's a really, I would say, cohesively beneficial ecosystem.
Hey, Jake, appreciate your time this morning. That is Oklo co-founder and CEO Jake DeWitte from the barbecue capital of Texas.
I'm sold.
According to producer Val.
I love the story. It's such a cool, the way he sells it, and he sells it well.
Right.
It's such a cool, integrated solution, and I love to watch. The stock has come down lately, but it's over the last few years up 500%.
Right. It's been down decisively this year. So I think there is just this question. The promise is there, but how long does it take to actually fulfill the promise?
We'll watch as Jake does it, and hopefully continues to come back on this program. Let's get a check of what's going on in the markets this morning. We see the S&P 500 down almost 1%, the Nasdaq down almost 2.5%. Right now, you can see SpaceX stock is actually gaining. It's up 2%. It had been down at the open in the first few minutes of trading. It was down lower than it opened up on its first Friday of trading, so lower than $150, but we're back up now to $157.5. And Brent crude, just so you know, holding at that $77 level that we've seen the last couple of days.
Some of the single stock movers that we are also watching this hour. FedEx releases its first earnings after the bell since it spun off its freight business earlier this month. Shares down 1%.
ServiceNow was given an overweight rating by JP Morgan with a price target of $145, and you can see the stock up to almost 97, a gain of 4%.
Also gaining today is Netflix, but it's bouncing back. Kind of bouncing back, up 0.6% yesterday. It hit its lowest level since 2024 on news that Meta is exploring TV for social media, more vertical videos for Matt, which he loves just so much.
I don't get, Facebook is going to eat Netflix's lunch? I don't think so. Coming up, Brent trades below $78, as we just showed you. Traffic in the Strait of Hormuz picking up. We'll head to Washington for the latest on the U.S.-Iran talks. This is Bloomberg Open Interest.
If the sanctions go out, money's going to be put into this country. All that money's coming back in the form of purchases of food, which they desperately need.
Can you ensure that the Iranians won't use profits from oil sales to rebuild their military?
Well, they're not supposed to be doing that, so we'll see, but they're supposed to use money to buy food for their people.
President Trump speaking yesterday from the Oval Office, and Iran says $12 billion in frozen funds could soon be released. With the U.S. also waiving sanctions on Iranian oil exports, Trump says Iran will only be able to use funds released from frozen accounts to purchase food and medical supplies from the U.S., as you heard there. Let's get the latest. Bloomberg's Kayleigh Lyons, co-host of Balance of Power. And Kayleigh, Trump and the U.S. have been clear that these funds will be under U.S. control. Do the Iranians also agree with that account?
No, they don't. Once again, Dani, we're seeing conflicting of the different narrators' messages here, which are obviously catered to each of their domestic audiences. And while President Trump maintains that, yes, any money that is unfrozen will be held, he says, in escrow used by the United States in order to purchase U.S. goods like soy or corn, for example, to feed the population of Iran. Iran's foreign ministry says that they will be able to use the money freely in whatever manner they wish. So there is a bit of a difference there. In the understanding around this, at least in terms of public messaging. There also is a difference in terms of the messaging we're getting regarding inspectors of Iran's nuclear program. The president said on True Social again today that Iran will allow weapons inspectors long into the future. He says infinity in order to ensure nuclear honesty, while Iranian's foreign ministry has pushed back on that notion around nuclear inspection. So clearly there are still some major issues to be ironed out. That said, we are early in the negotiating process. It was just round one in Switzerland, and obviously technical level negotiations are continuing through this week. But the nuclear program remains one of the key issues in what Iran will have unlocked in order to extract concessions on its nuclear program. But there are other questions as well regarding Lebanon and Israel's operations against Hezbollah, as well as the fate of Iran's ballistic missile program, which President Trump has suggested may not need to be addressed in these negotiations.
Right. I mean, he kind of implied that he was okay with them having still a few ballistic missiles. Their neighbors have them, so they can have them as well. Right. And the same with enriching uranium for nuclear power plants. Is this going to turn out to be at least a match to the JCPOA? I mean, I know that the Iranians are going to get paid at least twice as much as they did under that agreement, but are we going to have to call like a month in advance to get nuclear inspectors in, make an appointment? Are they going to still be able to have their nuclear energy plants all around the country?
All excellent questions, Matt. Yes, there are many in Washington who say that this is sounding very familiar in terms of the architecture of what's coming together here to the JCPOA agreement of 2015, where, of course, it was hinged on major weapons inspectors having access to Iran's nuclear development. Although we now know, given the extent to which Iran was able to continue to enrich uranium even after President Trump pulled out, or before President Trump pulled out of the deal, that there was a transparency issue. Inspectors weren't able to see everything Iran was doing underground. So even if they were to allow weapons inspectors in this go-around after a negotiated potential outcome here, there could still be questions around the real visibility that the world is able to get into Iran's nuclear program. All of that said, President Trump also maintains that there is still a lot of knowledge we can glean just from our satellites that are able to look at Iran's nuclear facilities, know if there is any activity going on there. But clearly there will still be some information gaps that Iran may be looking to exploit.
One of the things that is decidedly different this time is Iran's control over the Strait of Hormuz. And Kayleigh, there was a story a few hours ago saying that Iran and Oman were working together to try to manage Hormuz transit costs and to manage the flow of vessels through there. Is that something that the United States would be okay with having Iran have any bit of control still over the Strait of Hormuz and maybe eventually charge tolls too?
No, this is something that Vice President J.D. Vance, who, of course, is leading the U.S. side of negotiations, has pushed back against, saying there will be no final deal if it doesn't guarantee free passage through the Strait of Hormuz. That said, Iran has repeatedly suggested that they and Oman could have some kind of system in place after this 60-day negotiating period expires. So it's going to continue to be a point of contention and one that Gulf states, allies of the United States, also likely very much care about the outcome here. And it'll be interesting to hear what we hear in terms of messaging from them or readouts that we have from Secretary of State Marco Rubio's visit to some of those countries this week. He's traveling to the UAE, Kuwait, and Bahrain, obviously going to be talking to them about the way this deal is coming together, but of course guaranteeing that their energy exports can continue to be exported through the Strait of Hormuz easily and toll-free is going to be of high interest to those countries.
All right, Kayleigh, thanks very much. Kayleigh Lyons there, co-host of Balance of Power. You can catch that program at 1 p.m. on Bloomberg TV and then again at 5 p.m. On Bloomberg TV and radio. Coming up, the CEO of Porsche promises a leaner lineup as profit pressures mount. That's next. This is Bloomberg Open Interest. get a check on the markets right now. You can see the S&P down 0.9%, 7,400 the level there. The Nasdaq trading at 29,600. It's off 2.5%. And just in case you're keeping track, just in case you bought shares, hopefully before they started trading, SpaceX is up 1.7% at 157. Now Porsche shares P911 at GY remain under pressure as the car maker moves to cut the number of models it produces. Porsche's new CEO says the portfolio has become too complex. We're joined by Bloomberg's Detroit bureau chief, David Welch. And David, I guess they have the Panamera, the Taycan, the Cayman, the Boxster, the 911, the Macan, and the Cayenne. So that's 7 by my count. What are we looking at in the future?
I'm not sure if it's necessarily models. They have a lot of trim levels for each one of those models, which is a lot of manufacturing complexity. I mean, if you wanted to trim one, do you need, all the sports cars that they have, given the size of the sports car market? I mean, they would have to keep the 911 because it's the name, it's iconic. But do they trim some of those other, smaller sports cars that are expensive toys for people? Maybe, but I think there's probably a lot of complexity, just trim levels, different options and things, and maybe they start to cut that, but they just don't have enough volume, especially given their global issues, right? It's very difficult and expensive now to export to the U.S. The China business is tough. The Chinese don't really want foreign automakers having a big presence there. If you're going to play in China, and General Motors has realized this, you have to export from China to other countries. The Chinese market just has too much capacity, but if you're willing to export and keep people employed there, the government will kind of let you keep going that way. So Porsche struggled there too. And what you're seeing are a bunch of methods to cut costs and kind of maintain their earnings while they figure out how to try and grow this thing again.
How much pressure do you think, David, they're getting from Volkswagen? Because isn't Porsche traditionally like the crown jewel of the group?
It is. Look, the luxury business makes a lot of money, and Porsche is one of the, it's creme de, we're talking creme de la creme of the luxury business here, because they do sell expensive cars, and they're actually in pretty decent numbers. This isn't like Bentley or something where you're talking a few thousand vehicles a year around the globe. They've got pretty good volume. And Volkswagen plays in the mass market. It's very tough in Europe to make money in that market because literally everybody, the Chinese, the Koreans, Japanese, Ford, are all competing there with basically small cars and small crossovers. So the pricing and the margins aren't very good. China's a tough market now. There are price wars there. And Volkswagen's never really cracked the code in the U.S. So they got to make their money someplace. And Porsche's always been a big engine for them. So, yeah, there's going to be a lot of pressure there to get that company and that brand back to printing money the way it used to.
It used to. When I started covering this company 26 years ago when Matt Winkler required a size and scope in every 4-paragraph lead. And for Porsche, it was always the most profitable car maker in the world. And we've fallen pretty far from that time. David, thanks so much for joining us. Bloomberg's Detroit bureau chief, David Welch. You can listen, by the way, to my podcast. It's called Hot Pursuit. If you care about cars, with Hannah Elliott from Bloomberg Pursuits, we drop a new episode every week.
Exciting. What's this week going to look like?
I don't know. We'll decide when we record it on Friday. Well, a lot could happen between now and Friday. Coming up tomorrow, BlackRock's Gargi Chowdhury joins us, Carlyle's Jason Thomas, Mountain CEO Mark Douglas, and Philip Richter of Hollowbrook Wealth Management. This is Bloomberg Open Interest.